Ooh. That is my mistake. I'm sorry about that. Sorry. Okay. All right, there. Just go ahead and copy it down. You guys heard me talking the whole time, but you guys didn't even get to see the screen. All right, you guys should be able to see the screen now. Sorry about that. I had no idea I didn't put screen share. All right, so go ahead and copy all that down. All right, go ahead and copy that down, and we'll get started again. Okay, like I said, I'm going to be showing you guys exactly what I mean by all these things in a minute. Okay, so I'll give you guys another minute. All right, so these are the rules for trading a W. Actually, you know what? I made another mistake. I just realized. Okay. Well, it's basically the same mistake. Second, oh no, that was right, but second leg, first candle. Okay, so second leg, hang on 1 second. So the second leg, the first candle confirmation will be a quick move, okay? So the first candle of the second leg, I kind of did that reverse, but you get what I'm saying, okay? So on the second leg, the first candle confirmation will be a quick move, trapping traders short, okay? Now we're moving on to the next slide. Whoever didn't get to write the whole thing, just go ahead and interrupt me, and I'll change it back. All right. So I'm gonna show you guys exactly what I mean. Okay, so right here, the overall trend is long. The thing is, I'm not able to show you the 3+ days because we're on the 15-minute chart, so it only shows 1 full day. But just believe me that the trend is actually long. Okay, so with a long trend, I told you guys to look for W formations. Okay, don't look for M, only W formations. Okay, so as you can see here, I highlighted what could potentially be a W formation at the bottom right. Okay, what could potentially be a W formation. Okay, so this is exactly what you would see on your charts. You wouldn't see the full W formation form just yet. This is half of the W, okay? So it comes down. Look how heavy it drops, okay? This would convince traders to go short. This would convince traders to go short, okay? So people are taking shorts because it's moving so fast down. Oh my God, momentum is moving it so fast down. I need to take a trade before I don't get the opportunity anymore. So people are taking trades short. They're putting high lot sizes, taking trades short, and oh, it stops right here and it moves up a bit. Okay, don't panic. It's okay. It only moved up just a little bit. I know it's still gonna go down. Okay, that's what retail traders are thinking in their head, and the market makers already know what they're gonna do. So they go down and do shorts, come back up a bit. Next slide. Look what they do. They come back down. The retail traders are thinking, yes, I'm right. It's coming back down. I knew it was going to come back down. I'm going to keep my trade open. It's okay. They're wrong. They come back down. They retest the first level of the W, the first leg of the W. They come back down, retest it. Okay? When moves like this are made and the price comes back down to retest and doesn't break it, W formation, you take the trade off the second candle. Okay, now now when fast moves like this are made, many times fast moves like these are made, momentum moves as some people may call it, they are made because the market maker is trying to plan something. Okay, they already know what they're going to do, so they move the market quickly to collect contracts, to collect traders, to collect trades. Okay, they moved it so fast, people started putting sells. They moved it for a reason, because they wanted to trap traders. All right, so that's one way the market maker thinks. That's how they plan things ahead. Quick moves to cause panic and make people make irrational decisions. Okay. All right, so on to the next slide. Now the M formations. It's basically the same thing as the W formation, but it's flipped. Okay, but I still want you guys to write it down, just so you guys have it. It's basically the same exact thing. So now, how do you look for M's? What trend must it be first? Short trend, and then you look for M's. Okay, you don't look for W's on a short trend, you look for M's. So the first thing you must do before even considering any kind of formations, recognize the trend. I want you guys to write that on the side. First thing to do, recognize the trend. All right, so peak formation high is made. So the peak formation high is made. There's a pullback. Traders went long because the market maker induced longs. Then it comes back down a bit. Those who are trading long believe that it's still going to go up because so much momentum. Oh my God, it's still going to go up. I believe in this. So it does go back up a bit to retest the high. So traders keep their trades in. So when it goes up to retest that high and does not break it, what do we have? Second leg of the M, not the W. Don't get confused. It's supposed to be M. Don't panic. Okay, so when the price goes back up to retest and does not break, second leg of the M is made. Okay, and the entry is the same exact as W formations. Take entry on the second candle. When the first candle confirms the second leg. Okay. Hold on. There's something else I have to edit. First leg candle confirmation will be a quick move. Okay, so I'm gonna change this really quick. First, no, I should have kept that in. First candle of the second leg confirmation. First candle of the second leg confirmation will be a quick move. Trapping traders long. Alright, so write that one down. That one's updated. First candle of the second leg confirmation will be a quick move. Trapping traders long. M formation, market makers want to trap the traders long because they're going short. Alright, so I'm going to move on to the next slide. Whoever didn't copy everything down, just go ahead and interrupt me and I'll move back. One second. Okay, it looks like I didn't put an M formation. I guess I forgot to take a screenshot of M formation and post it. So what I'll go ahead and do is I'll just show you guys off of this real quick. Okay, I'll go ahead and look for information for you guys. Alright, so there's a couple in here. Alright, off a W formation here, but I'll go ahead and delete that. Now this is the day chart, okay? So each candle is a day. All you need is 3 candles to determine the trend here. Alright. I'll go ahead and look at the hour chart. Alright, here's a perfect information. Actually, this is the one I was supposed to post. I don't know why it didn't post. Okay, I already had it marked up and everything. So this is a clear M formation here. Clear M formation. Okay. Second leg did not break the first. Okay, as you guys can see, second leg did not break the first. That's one of the first confirmations. All right. Now you can see how far it wicked up there, but it's still, the body needs to close below. I don't care if the price went up there and it wicked. Okay, the body where it closes, that's what matters. So the body closed below the first leg. That's the confirmation. Sorry. So then it dropped. Okay, after it confirmed the M, you would take your entry right at this candle. After this long red candle, you would take that green candle entry. Okay. All right, so you guys got the M down. Basically, the inverse of a W. All right. Where did my thing go? Okay. All right, hold on. So I have a question. Sorry, I didn't see it. So when the market maker make the big moves, does it mean there will be a retracement soon? Yes. Some people call it retracement. What I call it is stop hunts. Okay. Stop hunts, what they are. 1 second. Stop hunts, what they are is people take profits and stop losses when they're away from the computer, away from the phone. They can't check their current trade that's on. They place stop hunts and stop losses. Okay. Now, what it's for is basically a safety net. If you take a W formation and you place a buy on the second candle of the second leg, but it decides to come back down and retest the low for a third time, okay, you put a stop loss. And that stop loss is your safety net. So if it comes down to where you put your price, you bought, it'll automatically close your trade out. Okay. So many traders do this. So for me and the market maker method, it's not considered retracement. It's considered a stop hunt. The market makers are moving the price back up to hit your stop loss. Okay. All right. So I'm going to go ahead and explain these here. One second. I have another question here. One second. Okay. All right, so I need you guys to. All right, so we'll go ahead and take a look at these examples. All right, so based off of what I just taught you guys, we're going to look at this, okay? W formation right here. All right, first leg is formed, peak formation, and it comes back up, drops down to that price point, okay? And it does not break it. Now, I mentioned that the first candle of the second leg must make a quick move, quick pullback. Okay, This is called this is called, let me not, I always get these words confused, but let me just make sure really quick, say the right word. Engulfing, I believe it is. Yeah, engulfing. Let me go back to the slide. Okay, this is called an engulfing candle. What an engulfing candle is, it basically devours the previous candle. It manipulates it, basically. Not manipulates it, it just devours it, it destroys it. Okay, so here, the second leg here, the red candle drops, okay, and look at the next candle, the green candle. It doesn't break the first leg, and it shoots up. It shoots up so quick. Like, this is a quick move right here. These are the quick moves I'm talking about, okay? So it shoots up quickly, and it completely overpowers the previous red candle, okay? And when it closes like this. So you have to make sure first it closes this way, okay? It has to be a quick move. Sorry. It has to be a quick move to pull away to trap traders short, okay? This long red candle here that started the second leg of the W, that induced short traders. Many traders took shorts there because they wanted re-entry. Okay, they wanted re-entry. They wanted to get more money. They started to begin to be greedy. All right, so this is what you can't fall for. You can't fall for these things. Okay, so that's why you wait for the second candle of the second leg. I'm sorry, first candle of the second leg to close. And that's this blue one right here. Okay, you wait for it to close, then you take your entry off the candle right after. Okay, that will be your entry, that small little red candle right there. Some people call it a doji. Okay, that's your entry. Yeah, it does retrace back down a little bit, but still, that's your entry. You're still going to get money. This is where risk management comes to play. Don't place big lots. Use risk management. Okay, if you have a small account, make sure you play small lots because it can retrace like this. It's not going to always look pretty, but second candle, get in. And if it does go down like this, okay, get another entry. That'll be even a better entry, okay? But make sure that you wait for a big candle like this with a quick move away from the first leg price. One second. Okay. So that's a typical W and M formation, okay? It drops and induces sellers, comes back up, hits stop losses, and it worries traders a bit, but they still believe that it's going to go down. So look, it goes up, hits stop losses, and they start dropping again. They're like, oh man, maybe I put my stop loss too short. Maybe I put it too close. I'm gonna go ahead and put another sell because maybe I was wrong. I'm pretty sure this is gonna go for a sell or gonna go short because it's still dropping again. Okay, so enough of falling for it. Enough of falling for that stuff. Okay, if it comes back and retests the peak formation low but doesn't break it, you take that trade off the second candle after the second leg is confirmed, which is this candle here. Okay, quick move, entry on the second candle of the second leg. All right, now off to the next one. All right, here's another one. And what helps a lot, what you guys can do, here, let me show you an example off of, sorry. Let me show you guys an example right now. Marlon, what do you mean by an exhaustion candle? Oh, okay, so the question was on that pullback. Let me go back to it. Okay, so I believe he's talking about this pullback when, okay, so you get entry on the second candle after the first candle confirms the second leg. Okay, and then it starts to pull back a little bit. All right, so I believe that's what he's talking about. So on that pullback, would you wait for a exhaustion candle to re-enter? What he means by exhaustion candle, he means a doji or hammer, basically a candle formation to re-enter. No, you wouldn't look for a specific candle pattern. Okay, what you look for is, so here the pullback is made. Okay, now the pullback is made, but the W is confirmed, so you know it's going to go up. Okay, as long as you use risk management and your lot sizes are good and you're able to put another trade at a certain price, or you can put another trade at this long red candle here. You can put it at the short one. You can put it when it wicks this blue one right here. It doesn't matter. You know it's going to go up because it's a W formation. Okay, so you are able to take the risk because the risk has been minimized when the second leg was confirmed. So it's going to go up. You can't take the risk. Okay, I hope that answered your question. You don't look for a specific candle pattern. You just see a pullback, a small pullback, and you take entry. Okay, so if that wasn't the greatest re-entry, then that's fine. It's still gonna go up. All right, now another question: would it be okay to enter on the consolidation area between? Okay, so he means right here in between the first leg and the second leg, I believe. Just to be sure. Oh, the top of the pullback. No. So he means the after the second candle of the second leg. This period here. Okay, so would it be okay to enter on the consolidation area between on the top of the pullback, just to be sure? Yeah, it would be okay to enter a trade there. It would be okay. This area here after the second candle where you're supposed to enter, you can enter another trade there as long as it hasn't hit your exit area, meaning to exit the trade. As long as it hasn't hit that area yet or it's not close to it yet, then it's fine. And don't worry, I'm saying exit area. I'm going to explain that right now, okay? Because I'm going to teach you guys where to exit the trade. And I'm teaching you guys now where to enter it. So now it's time to teach you guys where to exit. All right, so here's another W formation. First leg is made, peak formation low, pops up, and then look at that. It came back down and was so close to retesting that low, but it didn't break, and then it pulled back up, came back down. That's considered actually 3 hits to the low, not even a W formation. That's considered 3 hits to the low. Okay, so right here, it's confusing the traders. It's going down, then came up, then came down, retested the low, pulled up so quickly, then came down again and retested the low, but did not break. Okay, the best confirmation you can get is 3 hits to the low or 3 hits to the high and does not break. You take that trade. You take it every single time. 3 hits to the low or 3 hits to the high. That's 3 legs on a W, so it would be a deformed W, okay? It's fine. 3 hits to the low, 3 hits to the high, deformed W, deformed M. Whatever you want to call it, it doesn't matter. All right, so you take that trade. That's one of the strongest trades to take. It's 3 hits. Yeah, there's 4 hits too, but I wouldn't take that trade after 3 hits, okay? So if there's 4 hits, then ignore the pair. It's acting weird, okay? So either 2 hits or 3 hits. That's it. No less, no more. All right, so on to the next slide. Here we go, entries. and actually entries and exits, W and M formations. Okay, 1 second. All right, so go ahead and write this down. So this is the rule for the entries. I want you guys to write it down. If any questions so far, go ahead and ask the questions on the post I made on Forex 2016 with the link, or if you're on my market maker training, you can go ahead and ask it on the comments or on the message. One second. All right. So when the price comes back up or down, depending whether it's the W or M, to the price the first leg is, wait to see if it does not break that price, okay? So if it makes a peak formation low or peak formation high, and the price starts to come back up, you wait to see if it'll break the first leg or not. Pretty simple, guys. Pretty simple. All right, question. So regarding point 2, how far below M or above does the second leg need to be? Does 1 pip qualify? Okay. I've been getting asked this question multiple times. Okay. So the question is, basically the question is, how far does the second leg, or how close does it have to be to the first leg? Can it be 5 pips away? Can it be 10 pips away? Can the second leg be 10 pips away of the first leg? It can't be 10 pips away. It can't be 5 pips away. He asked if 1 pip qualifies. 1 pip, I believe, does qualify. Okay, so if it's 1 to 5 pips away, I'm making this a new rule. Okay, if it's 1 to 5 pips away from the first leg, take entry, because I'm about to show you exits that will make that formation safe. Okay, but it will be much riskier than the second leg hitting the actual first leg price. Okay, it would be 20% riskier to do that. All right, so I hope that answered your question. You can trade 1 to 5 pips max. Anything above 5, don't take the trade. Okay, but it will be riskier because it didn't come down to the same price point. But it still is tradable. I know people that are able to trade those formations even though it didn't come down all the way to the first leg. That takes time and experience to master. So if you're willing to put in the work, then go ahead and do it. I recommend it because that's more money you're able to make, but that's also more money you're going to be risking. Okay, that's all on you. The way I'm teaching you is price has to touch the first leg. Okay, that's the way I'm teaching it. Another question, stop losses. Many say they don't trade with stop losses when they are watching the charts. Is this advisable? It depends, honestly. Depends how many trades you have open, and it depends whether you're away from your computer or your charts. Okay. When you're away from your charts, put a stop loss every single time, because once again, it's better not to lose your whole account, because I'm pretty sure everybody has seen the market move so many pips in just one candle. Okay, I don't want that happening to anybody. Unexpected news or anything like that move the market so much. So if you're stepping away from your charts, put stop losses. Put the stop losses, okay? And I'm going to tell you guys where to put stop losses today if I have time. All right, so put stop losses when you're stepping away from your charts, and also put stop losses if you have 3 or more trades open. The reason why I say that is because if you have, one second, if you have 3 or more trades open, it's much more difficult to go to each trade and having to close it so quickly, because the chart can move that fast. Okay, so get rid of that stress of having to do that. If you have 1 or 2 trades, okay, that's fine. You can close your trades manually and it'll be fine. But if you have 3 or more trades open, it'll be more difficult to close a trade out, because what if all hell broke loose and everything started to move so quickly? You won't have time to be able to click all the trades. So stop losses when you have 3 or more trades open, and stop losses when you're stepping away from your charts. All right, so another question. So the exact same price point is okay, just not exceed. So 0 to 5 fit between legs. So the exact same. Let me see. Hold on 1 second. Okay, so this person asked, so the exact same price point is okay, just not exceed. Okay, so if I hope I'm understanding your question right. So let me explain it one more time. So the first leg comes down, makes a peak formation low. Let's talk about a W. Makes peak formation low, comes back down. Okay, so second leg starts to form, comes down, retest the price. Okay, it doesn't matter how long of a wick it leaves, as long as the body closes above the first leg on a W. I don't care how long the wick is. Okay, and in regards to not touching that first leg price, if it doesn't touch that first leg price, like I said, it's much more riskier. Okay, I take W's and M's of the second leg touching the first leg price and not breaking it. Okay, and I'm talking body to body. Okay, body of the first leg and body of the second leg. Those are the trades I take. But that's the way I'm training it. And the other question was, what is the max number of candles you want to see in the first leg? It doesn't matter. I don't care how many candles there are. Many things like that can happen. The first leg can have 5 candles, or it can have 3 candles, 2 candles. Okay, it would never have 1 candle. Well, actually, no. Yeah, it would never have 1 candle. Otherwise, it would open in a gap. So it doesn't matter how many candles is in the first leg or second leg, as long as it doesn't break the first leg. Anybody. So if there's 5 candles on the second leg, as long as those 5 candles do not break the first leg, then it's fine. Thank you, Drazy, for posting snapshots of the presentation of the notes. All right, 1 second. All right, everybody, I'm pretty sure give enough time to put these notes. So off to this. All right. So I'm about to teach you guys exits. Okay. M formation's made. Second leg does not break the first. So that's confirmed. Okay. Second leg does not break the first. Then immediately what we see off the second leg is we see a major quick move and an engulfing candle right here. You see this white box right here? Okay. That's what I want to see. A quick pull away. Market makers induce longs here. All through here, they induce longs. And then randomly, they decide to go to this first leg and not break it. There's a reason for it. They don't want to let these traders out because there's still traders stuck over here. Okay, if I were to place a long trade, I would place it somewhere over here and it's going long. Okay, then it drops and I'm like, okay, it's okay. I'm barely in the negative. I know it's going to go back up. So then it starts to go back up. So I place another trade because I knew I was right. It's going back up. But oh no, it drops so fast that I can't do anything about it. It drops and I'm stuck. I'm stuck in the negative. I don't know what to do. So I keep it and pray that it's going to go back up. That's a retail trader's mindset. That's not going to be your mindset because you're going to start thinking like a market maker. Comes up, forms a second leg, makes a quick pullback, closes, confirms the M formation. You take entry off this green candle right here. That's it. Simple as that. Confirm the second leg, take entry off the second candle. All right. Now, where would you exit? Okay. So let me see. 1 second. 1 second. 1 second. All righty. Here we go. This is where it gets fun. Support and resistance. I'm about to show you guys how to trade with support and resistance the market maker way. Show you guys how to exit. Show you guys things that you probably never imagined before. Support and resistance, okay? Otherwise known as R-S. Alright. Alright, so what is this? These are horizontal lines drawn from where traders have gotten trapped by the market maker. So as I was explaining before in the previous chart, people took longs, then it came short, formed the first leg, went long again, formed the second leg, and dropped. Traders got trapped. When it makes the M formation, retail traders get trapped. They get trapped long when it's going short. Okay? That's what I mean by trapped. Alright, so places traders could have been trapped are in zones of consolidation. And consolidation is when the market is moving sideways. 1 second, guys. All right. So consolidation, when the market is moving sideways. And as I explained before in the vocabulary, the market moves sideways because the market maker is collecting contracts. He's collecting trades. Okay. He's moving it sideways. People become impatient. They want to place a trade already. They want to make money. They start to get greedy. They start placing trades when the market is moving sideways. That's consolidation. Market maker does it on purpose. It's not that he doesn't know what to do. He's doing it on purpose. Okay. Other places are W and M formations. People get trapped in W and M formations. W formations, people get trapped going short when in reality it's going to go long. M formations, people get trapped long when it's going short. All right. Movements affected by news, such as NFP, FOMC. These are major news that affect the market. And quick movements in the market. Quick movements can be the news or just random quick movements in the market affected by a disaster or anything like that that may have happened somewhere in the country or stuff like that. Okay? So these are places where traders could be trapped. All right. Resistance and support could be used to determine where entry or exit of a trade can be placed. Okay, so we can now not only focus on W and M formations, we can use resistance and support to take entries and exits. And I will show you guys how to do that. Okay, we have 5 minutes left. I'll probably go over it just by a few minutes. All right, so as I said before, resistance and support are drawn as horizontal lines indicating the price area of where the traders got trapped. To draw the support and resistance, you must draw them at the highest or lowest body of the candle. And I'm going to show you guys right now what I mean by that. Okay, but it has to be on the body. You can't draw the lines on the wicks. It has to be on the body. All right. Here we go. Let me know if you guys do not if you guys didn't copy everything. I'm pretty sure I gave you guys enough time to do so. Okay, so here's the first example. Highlighted in the orange box, that is consolidation. How is it consolidation? Because the market is moving sideways. The market is moving sideways in this orange box here. Market makers are collecting contracts. All right. So that is where traders got trapped there. Okay. Now, as you guys can see, I drew a line, an orange line above that, right above the top candle. The reason why is because people are going long here. So there's a lot of long traders that are trapped right here. Okay. Okay, and then randomly it spikes and then it drops. Okay, so right here, consolidation period, I would put a resistance or a line on the body of the highest candle. Okay, in a consolidation period. All right. Hope you guys understood that. Pretty simple. That's an example of consolidation. Now here's the M formation, okay? Now traders got trapped on the M formation because they thought the market was going long. One second. Just want to make sure everybody is still good to go. All right. All right, M formation. Traders got trapped at the M formation. They got trapped on the first leg and the second leg. Why? Because they put longs before the first leg. Then it dropped. They put longs when it started to rise for the second leg. And they got trapped there too. All right. Now you would draw your lines on top of the body of the highest first candle on the first leg. So it would be the first leg and the second leg. You would draw two separate lines if the bodies are they closed in different areas. Okay, if they close in different prices, excuse me, if they close in separate prices, you put one line for the first leg and one line for the second leg. Okay. Now I want you to look at what price did. One second. So the question was, you put resistance, or basically you put a line only on consolidation period or somewhere else. You put it, as the note said before, you put it on consolidation periods, you put it on M formations, W formations. You put the lines wherever traders got trapped. Okay, wherever there's traders that are stuck, or wherever traders have been stuck before, you put lines there. Okay, so you drew these two lines right here. Okay, you drew it out the top of the first leg and the top of the second leg. These two legs had different prices where the body's closed, so you draw two separate lines. Okay, now after the M formation was formed, it dropped. Okay, it did what it was supposed to do, what I trained you guys to do. It dropped after the second leg did not break the first. Dropped. Okay, then price started to go back up. All right, now look, it came back up to the line of where you drew before, where that M formation was made, and it wicked it. That's resistance. That is resistance. It wicked it. The reason why it wicked it is because it did not want to release the traders that were stuck at the M formation. It did not want to release them. They weren't ready to release them. Okay? They're waiting for them to either take their losses, get out of the trade so that the market makers can take their money. They're waiting for this stuff, okay? So they went back up, but they did not close above it. This is acting as resistance. So basically picture it as, okay, if you throw the ball up to the roof, it's going to hit the roof and then, the ceiling, I'm sorry. If you're bouncing the ball inside a room and stuff and you throw it to the ceiling, it's just going to bounce back. That's how you should picture it. This is the ceiling here. It went up and it bounced back. It did not break it, okay? Now that is why I say you guys can use this as resistance, because traders are trapped there. The market makers do not want to release them yet. All right, and then it bounced back and it started to go short. It started to drop, okay? All right, looks like that was the last slide. Wow, that's perfect timing. Let me show you guys a couple more examples because I don't feel like I showed you guys enough. right. All right. That's the information I was talking about. Okay, look at this one. M formation up here, and then it dropped. It formed a W formation down here. See, that's not the most beautiful W formation, but it still came down and retested that first leg, right? Perfect. When did this happen? 22nd of January, around that area. Okay. First leg was formed. It dropped, then started to bounce back up. Okay. Then it started to drop again. All right. It started to drop. So now what do you do? What do you do? You recognize the peak formation low. You recognized it. It pulled away so quickly. So what you do, you draw a line right there. Okay. You draw a line right there. All right. Now you wait to see if price is going to come back and retest that. Now price started to come back, and look at that. It retested it. Retested it. Did it break it? No, it did not break it. All right. Now, let me zoom in. Came down, made the first leg. 1 second. Yep, Marlon, you're definitely right. You could have easily made bank on this one. All right, so made the first leg, came up, retested the first leg, okay, but it did not break it. Entry on the second candle. Look at this candle right here. It's engulfing, right? Look at that, engulfing this one here. Now, this is a question from someone earlier. How many candles does the leg have to have? It doesn't matter. This is 1, 2, 3. These are 4. 4 candles right here. It doesn't matter. As long as it doesn't break this, it's fine. But we have a candle right here, the second candle of the second leg that retested that, and it's engulfing this one. Okay, it's basically the same size as that one. Okay, so you take your entry off the small candle here, and look what it did right after. Started to rise. Perfect. Second candle entry. That's it. All right. Now I'm going to show you guys the intro of exits really quick, and then I'll let you guys go. Second. Okay. This is off the hour chart. So the M formation was made. All right. M formation was made. M formation, you're expecting a drop. Okay. So you're supposed to draw your support and resistance lines up top over here. Okay. So you already drew that one. Came back and retested. All right. So look at these over here. Okay. You can draw support and resistance anywhere or everywhere that a trader got trapped. Okay. And there's many places that traders got trapped here. But specifically these two I want you guys to look at because these two are the main ones. All right. So here traders got trapped off this orange box. Traders got trapped right here. So you draw a line. Traders got trapped. They went short right here. They hit the stop losses. They went for the stop hunt. So you put a line right here where trader just got trapped, and you put another line here where trader just got trapped. You can put another one right here. You can put another one right there. You can go right there. That's fine. Each line that you draw where traders got trapped, it will always stutter to break it. You'll be able to see that once you start drawing them yourself. All right, so this orange box here, the first one, it drops. Now I want you guys to look at it. It starts to wick that line. Look at all these wicks towards that line. All these wicks towards that line. It does not want to break it. Look at that. Look at that. Look at that. Okay. But this would be your first exit. This line right here would be your first exit. M formation is made. It drops. This support would be your first exit. All right. Now, if you have multiple trades, if you ended up taking 2 trades, one with a higher lot size, okay, you let it ride. This would be your second exit because this is the second time traders got trapped on the way down from the M formation right here. Now, you don't draw the lines in the middle of the M. It always has to be on the outside of the M. So the first leg, that's when you can start drawing the lines. I forgot to mention. Okay, the first leg and out. Okay, you draw them before the second leg. Before, okay, because after the second leg is made, you can't draw any after, obviously. So draw it all before, on the first leg or before this first leg. Okay, I forgot to mention that. All right, so you draw this, stutters right here, does not want to break that. That's support. That's support. So that's your exit. That's easily, let me see. Off of this here, that's like 50, no, that's more than 50 pips. You almost have almost close to 70 pips, I believe, just off of this. That's your first exit right there, 70 pips. All right, so that's basically it for entries and exits. I'm gonna be going over exits again on Sunday. I didn't have enough time for to present it and stuff, so I'll go ahead and go over it again on Sunday. That way you guys can get a better understanding, because I know I didn't go through all of it with you guys, so I'm pretty sure you guys are still a little confused off of exits. So I'll go ahead and go over it on Sunday. Everything else you guys should have down. Basic rules of entries and solid M and W formations. So you guys should have all that down. There should not be a problem with that. But if you guys do have a problem with that, go ahead and ask me, because I need to get things cleared up with everyone, making sure everyone understands before I move on, because I don't want anybody getting confused. All right. So that's going to be it for this webinar. And like I said, this Sunday, it's going to be going over exits and some other material. And Sunday we'll have same time webinar, 11 p.m. Pacific time. And this recording will be edited and posted this week. All right, hopefully by before Sunday, we'll see. So that's it for tonight's webinar. And if you guys have any questions, just go ahead and message me or post it on the Forex 2016 page. And I'll be seeing you guys soon.